Friends, thank you for being here today. There is a financial system running in the background of your life. It is a silent operating system that the wealthy understand intimately and use every single day. You were never taught it in school. You were never meant to use it. In fact, most people have been actively steered away from ever seeing it. But once you see it, once you truly understand how it works, you cannot unsee it. What if I told you that the financial pressure you feel is not because you are not working hard enough, but because you are playing a game that was designed for you to lose? And what if there was a way to legally opt out of that game and step into the one played by the top 1%? The economy is not a single unified playing field. It is comprised of two distinct worlds operating under two fundamentally different sets of rules. The first world is the world of the employee, the laborer, and the high income earner. This world operates on a cycle of earning, being taxed, and then spending what is left. The second world is the world of the owner. This world operates on a cycle of leverage, compounding, and tax avoidance. The divide between these two worlds is not determined by intelligence or how hard one works. It is determined by a single critical distinction: the difference between income and equity. Most people believe that the path to wealth is paved with high salaries. They chase promotions, bonuses, and overtime, believing that a higher number on a paycheck equates to financial freedom. However, the tax code was not designed for workers, it was designed to reward owners. The moment you cross the line from earner to owner, even with just one rental property or a small portfolio of stocks, you are suddenly playing a completely different game. This is the owner's playbook. It is a fundamental, almost invisible system that the wealthy use to not just get rich, but to stay rich forever and to compound that wealth beyond what most people could ever imagine possible. Now, to really understand why the wealthy play a different game, we must first dismantle the illusion of income. For the vast majority of the population, financial life revolves around how much money hits the checking account every month. This is the rat race. You trade your time for money, and that money is taxed immediately. In the United States, high earners can lose up to 37% of their income to federal taxes alone. When you add in state taxes, payroll taxes, and sales taxes, a significant portion of your labor is siphoned off before you can even begin to build wealth. This is why the wealthiest people on earth avoid income completely. If you look at the compensation structures of billionaire founders, you will notice a peculiar trend. Many of them famously take a salary of exactly $1. They do not need a paycheck because they understand that income is the most heavily taxed form of money. Instead of income, they focus on equity. They hold shares in companies, real estate, and other appreciating assets. This strategy relies on a specific quirk in the tax code known as the realization principle. This principle states that you do not pay tax on the gains of an asset until you actually sell it. If you buy a house for $100,000 and 20 years later it is worth $1 million, you do not suddenly have $1 million in your bank account. The value is locked in the property. Because you have not sold the property, the Internal Revenue Service generally does not require you to pay taxes on that growth. This is called an unrealized gain. As long as you do not sell, you do not pay. The everyday worker falls into a trap. When their assets appreciate, perhaps their home value rises by $100,000, they feel the urge to sell and cash in on the profit. They sell the house, take the gain, and immediately trigger a taxable event. Depending on their income bracket, the government might take 15 or 20% of that profit in capital gains tax. The $100,000 profit quickly becomes $80,000. The worker has lost their asset, halted their compounding growth, and paid a toll to the government just to access their own money. This is the reset button that keeps the middle class from accumulating true wealth. Every time they score a win, the referee takes a cut and sends them back to the starting line. The wealthy understand that selling equals taxation. Therefore, the core rule of their operating system is simple: never sell. Instead, they utilize a three-step strategy known as buy, borrow, die. Let's start with the very first phase of this owner's playbook, the simple act of buying. The goal here is not to hoard cash, which loses value over time due to inflation, but to acquire assets that serve three specific functions. These are often referred to as 3X assets. A 3X asset is something that generates value in three distinct ways. It produces cash flow, it appreciates in value over time, and it offers tax advantages. For the ultra wealthy, this might look like acquiring businesses, intellectual property, or massive stock portfolios. For the aspiring investor, the most accessible vehicle for this strategy is real estate. Real estate is unique because it creates a natural hedge against inflation while providing tangible collateral that banks understand and trust. When a wealthy individual buys an asset, they are looking for lendability. They ask themselves, will a bank accept this asset as collateral for a loan? Stocks, bonds, and real estate are highly lendable. Art and classic cars can be lendable under specific circumstances. A savings account or a depreciating luxury car is not. The shift in mindset here is critical. The worker saves money to buy liabilities, things that take money out of their pocket, like a new car or a boat. The owner uses money to buy assets that put money back into their pocket. They are building a portfolio of equity. This equity is the engine of the system. It is the goose that lays the golden eggs. The worker eats the goose. The owner protects it at all costs. Once a portfolio of appreciating assets has been established, we have to answer the question, how do you actually pay for your lifestyle? If a billionaire has all their wealth tied up in stock and real estate, how do they pay for their groceries, their homes, and their vacations? This leads to the second and perhaps most counterintuitive phase of the strategy: borrow. In the middle class worldview, debt is a four-letter word. It is viewed as a burden, a trap, or a sign of financial irresponsibility. This is because the middle class typically utilizes consumer debt. They use credit cards with interest rates of 25% to buy things that lose value. They pay for this debt with after tax income, meaning they have to earn significantly more than the cost of the item just to pay off the principal and the interest. The wealthy, however, use systemic debt. They view debt not as a burden, but as a tool to access liquidity without triggering a tax bill. The fundamental truth that unlocks this strategy is this: borrowed money is not income. Because it is a debt that must be repaid, the Internal Revenue Service does not treat it as a taxable gain. It flows into your bank account completely untouched by the government. Let us examine the mathematics of this approach. Imagine a wealthy individual owns $1 million in stock. They need $100,000 to fund a year of living expenses. If they were to sell $100,000 worth of stock, they would trigger a capital gains tax. If the combined state and federal tax rate is 30%, they would have to sell approximately $143,000 worth of stock just to net $100,000 in spendable cash. Furthermore, they have now reduced their asset base, meaning they have less money compounding for them in the future. Instead of selling, the wealthy individual goes to a bank because they have $1 million in assets. The bank views them as a low risk borrower. The bank offers them a security backed line of credit. The individual borrows $100,000 against their portfolio at an interest rate of perhaps 4 or 5%. They now have $100,000 of tax free cash to spend. They still own the full $1 million in stock. If the stock portfolio grows by 8% that year, the growth alone covers the cost of the interest, and the asset base continues to expand. The cost of the loan is vastly lower than the cost of the taxes. This strategy creates a virtuous cycle. In real estate, this is often executed through a cash out refinance. Suppose an investor buys a rental property for $400,000. Over a decade, the tenants pay down the mortgage and the property appreciates to $500,000. The investor now has significant equity. Instead of selling the property and paying taxes on the gain, the investor goes to the bank and refinances the loan. They borrow 75% of the new value, pulling out nearly $100,000 in tax free cash. The crucial element here is that the debt is covered. The wealthy do not pay the debt, their assets pay the debt. In the case of real estate, the rental income from the tenants covers the monthly mortgage payments, the insurance, and the interest. The investor gets the cash, keeps the asset, and the tenant pays off the loan. It is a machine that generates liquidity without diminishing net worth. This is why billionaires can live lavish lifestyles while technically earning a salary of $1. They are living off borrowed money secured by their massive asset portfolios. They are essentially shorting the currency and longing the asset. They borrow a currency that is depreciating of the dollar to buy assets that are appreciating of real estate and stocks. As inflation drives the value of the dollar down, the real value of their debt decreases, while the nominal value of their assets rises. Now, while the buy, borrow, die strategy explains how to maintain wealth, there is a supercharger that allows high income earners to enter this cycle much faster, the zero tax snowball. For the typical high income earner, a doctor, a lawyer, or a software engineer making $300,000 a year, the biggest obstacle to building wealth is the annual tax bill. They are on a treadmill, earning, getting taxed, and trying to save what is left. To break this cycle, they need a way to shelter their active income. Enter the short term rental loophole. Traditionally, rental real estate is considered a passive activity by the Internal Revenue Service. This means that if you lose money on paper with your rental properties, you can only use those losses to offset other passive income, not your active W 2 salary. However, there is an exception for short term rentals, such as those listed on Airbnb or VRB, where the average customer stay is 7 days or less. If an investor acquires a short term rental and materially participates in its management, the activity is treated as an active business, not a passive investment. Material participation typically requires 100 hours of work per year, and the investor must do more work than anyone else involved with the property. Once this designation is met, the investor can utilize a powerful tool called cost segregation. When you buy a building, the tax code usually requires you to depreciate its value over 39 years. This means you take a tiny deduction each year. A cost segregation study allows an engineer to go into the property and identify non structural elements, carpeting, lighting, driveways, appliances that wear out faster than the building itself. These items can be reclassified as 5 year or 15-year property. This reclassification unlocks bonus depreciation. Recent tax legislation has allowed investors to take a massive percentage of that depreciation upfront in the very first year. Let us look at the numbers. An earner making $100,000 a year typically owes around $20,000 in taxes. If they buy a short term rental for $500,000, they can perform a cost segregation study. This study might identify $125,000 worth of depreciable assets eligible for bonus depreciation. Suddenly, the investor has a paper loss of $125,000 for that tax year. Importantly, this is not a real loss of money. The property is likely still cash flowing and appreciating. It is a loss manufactured on paper through the tax code. Because the investor materially participated in the short term rental, they can use this $125,000 loss to offset their $100,000 W 2 income. Their taxable income drops to zero. The $20,000 tax bill vanishes. Instead of sending $20,000 to the government, the investor keeps it. They reinvest that capital into their next property. This creates a snowball effect. The tax savings from the first property help fund the down payment for the second. The second property creates more depreciation, which shelters more income, which funds the third property. The investor has effectively stopped paying taxes and is using the government's own rules to subsidize their wealth building. They are compounding their wealth faster than the Internal Revenue Service can tax it. As your portfolio grows, you need a way to maintain momentum without hitting a tax wall. And that brings us to the 1031 exchange. There may come a time when an investor wants to sell a property to buy a larger, more profitable one. Perhaps they have 4 single-family homes and wish to trade them for a large apartment complex. Normally, selling those 4 homes would trigger a massive capital gains tax, destroying the equity they have built. To avoid this, the wealthy utilize Section 1031 of the Internal Revenue Code, commonly known as the 1031 exchange. This provision allows an investor to sell a property and roll 100% of the proceeds into a new like kind property without paying any capital gains taxes at the time of the sale. It is a deferral mechanism. The tax is not forgiven, it is kicked down the road. By continuously utilizing 1031 exchanges, an investor can climb the ladder of value, trading a duplex for a fourplex for a commercial building without ever letting the tax collector take a bite out of their principal. They can transact, upgrade, and relocate their portfolio for decades, carrying their original cost basis with them, growing their mountain of equity completely tax free. This creates a massive divergence between the wealthy and the working class. The worker pays tax on every transaction, every paycheck, every sale of a small stock, every purchase. The owner can go an entire lifetime transacting millions of dollars of real estate without ever generating a taxable event. This brings us to the final and perhaps most controversial phase of this strategy, which addresses the ultimate reality, death. The final phase of the strategy answers the lingering question. If you just keep borrowing and deferring taxes, don't you eventually have to pay the piper? Technically, yes, but if the strategy is executed correctly, that eventually comes after death, and the tax code provides one final miraculous escape hatch known as the step up in basis. To understand this, we must look at cost basis. If a person buys a share of stock or a piece of real estate for $10, their basis is $10. If they sell it for $100, they owe tax on the $90 gain. Now, imagine a grandfather who bought a home 50 years ago for $20,000. Over the decades, he borrowed against it to fund his retirement. He maintained it, and the market drove the value up to $2 million. If he were to sell that house while he was alive, he would owe capital gains tax on nearly $2 million of profit. That could result in a tax bill of $400,000 or $500,000. However, the grandfather does not sell. He holds the asset until he passes away. When he dies, the property transfers to his heirs. Under current tax law, the cost basis of the asset is stepped up to its fair market value on the date of death. The heirs receive the house not with the original $20,000 basis, but with a new basis of $2 million. If they turn around and sell the house the very next day for $2 million, their taxable gain is zero. The $2 million minus the $2 million basis equals zero profit in the eyes of the IRS. The decades of appreciation, the millions of dollars in wealth created, are transferred to the next generation completely free of capital gains tax. But what about the debt? If the grandfather had borrowed $1 million against the house to live on, that debt must be repaid. The heirs can simply sell the house for $2 million, pay off the $1 million loan to the bank, and keep the remaining $1 million tax free. The grandfather got to enjoy the liquidity of his wealth while he was alive without paying taxes. The bank earned steady interest on a secured loan. The heirs received a massive inheritance without a tax burden. The only party that did not get paid was the tax collector. This strategy can be optimized even further with life insurance. Ideally, the wealthy individual will hold a life insurance policy, often within an irrevocable trust. When they pass away, the life insurance payout, which is also tax free, provides the immediate cash needed to pay off any outstanding loans against the assets. This means the heirs do not even have to sell the property to clear the debt. They receive the pristine, unencumbered assets, stepping into the shoes of the owner to begin the cycle all over again. However, before one rushes to the bank to execute this strategy, we must confront the critical element that separates the bankrupt from the billionaires: the management of risk. While the mechanics of buy, borrow, die are mathematically sound, it is imperative to address the razor's edge upon which this strategy balances. To view this system merely as a path to easy riches is a dangerous oversimplification. The engine of this strategy is leverage, and leverage is a double edged sword that cuts both ways with equal indifference. When you borrow against an asset, you are introducing a new variable into your financial equation: obligation. The primary risk in this strategy is volatility. In the world of stocks, this manifests as a margin call. If a wealthy individual borrows against a portfolio of equities, banks will typically lend up to 50% of the portfolio's value. However, if the stock market crashes and the value of that portfolio drops significantly, the bank's collateral is no longer sufficient to cover the loan. The bank will issue a margin call demanding immediate repayment of a portion of the loan to restore the ratio. If the borrower does not have the cash on hand, the bank will forcibly sell the stocks at the bottom of the market to cover the debt. This is the nightmare scenario: forced liquidation at a loss, which not only destroys wealth, but triggers the very capital gains taxes the borrower was trying to avoid. In real estate, The risk is slightly different, but equally potent. It is called negative leverage. This occurs when the cost of borrowing exceeds the income generated by the asset. If an investor utilizes a variable rate loan to buy a property and the central bank raises interest rates aggressively, as seen in recent economic cycles, the monthly interest payments can skyrocket. If the rental income from tenants is not enough to cover these new higher payments, the property becomes a liability. The investor must then feed the beast from their own pocket every month. If they run out of personal liquidity, they face foreclosure. The asset is seized, the equity is wiped out, and the credit worthiness required to play the game is destroyed. This brings us to the antidote for these risks: liquidity. The wealthy do not survive market crashes because they are smarter, they survive because they are liquid. They maintain substantial cash reserves, often called a war chest, specifically to handle margin calls, vacancies, or periods of high interest rates. They never leverage themselves to the maximum limit. If a bank allows them to borrow 75% of an asset's value, the prudent investor might only borrow 40 or 50%. This equity cushion ensures that even if the market corrects by 20 or 30%, they are not forced to sell. Furthermore, they practice strict discipline regarding good debt versus bad debt. Bad debt is used to buy depreciating consumer goods that offer no return. Good debt is used to acquire income producing assets where the income covers the debt service with a healthy margin of safety. The wealthy individual never borrows money to fund a lifestyle unless the underlying asset can comfortably support that borrowing, even in a worst case scenario. Therefore, executing the buy, borrow, die strategy requires more than just assets. It requires emotional discipline and robust risk management. It requires the ability to remain calm when markets are red and the foresight to build a fortress of cash reserves when markets are green. Without this defensive architecture, leverage does not build a legacy, it digs a grave. The system is powerful, but it is unforgiving to those who disrespect the volatility of the market. So, what is the moral of this entire system? This financial architecture explains why wealth concentration tends to be sticky across generations. It is not illegal, it is worse, it is allowed. It is the explicit design of the system. The tax code is a series of incentives. The government wants housing, so it offers tax breaks to those who provide housing. The government wants business growth, so it offers tax breaks to those who own businesses. The buy, borrow, die strategy is simply the logical conclusion of following these incentives to their absolute limit. For the average person, the realization of this system can be frustrating. It highlights a game where the rules are heavily skewed. The worker is running a race, carrying a backpack full of rocks, while the owner is riding a bicycle. The worker is taxed on their labor, taxed on their spending, and taxed on their savings. The owner is subsidized for their debt and rewarded for their patience. However, the barrier to entry for this system has lowered. One does not need to be a billionaire to start. It begins with the psychological shift from consumer to capitalist. It begins with the decision to stop selling assets, to fund a lifestyle, and to start accumulating assets to support borrowing. It starts with buying a single rental property instead of a luxury car. It starts with utilizing the tax code like the short term rental loophole to keep more of your W 2 income. It starts with understanding that every dollar sent to the Internal Revenue Service is a dollar that cannot compound for your family's future. The strategy is a blueprint of good decision making. Buy appreciating assets, never sell them, borrow against them when rates are favorable. Use the tax code to offset your income. Pass the wealth on with a step up in basis. This is the game being played in the background of the economy. For generations, it was a game reserved for the elite hidden behind the closed doors of private banks and family offices. But information has been democratized. The playbook is open. The question is no longer about access to the information, it is about the discipline to execute it. You can continue to earn, pay tax, and spend operating within the system designed for workers, or you can step into the system designed for owners. You can buy, you can borrow, and you can build a legacy that compounds faster than the taxman can catch it. The choice ultimately is which operating system you decide to install for your life.